Welcome to NM's Arena. In this video, we are going to discuss about the financial institutions. First of all, we have to understand what is a financial institution. The financial institutions are the intermediaries who facilitate the smooth functioning of the financial system. They ensure this smooth functioning by making the investors and borrowers meet. They mobilize the savings and allocate them into productive activities that provides a good rate of return. So we can say that the financial institutions provide services to a whole range of entities like individual, business, government, etc. And they provide the service of raising funds from the markets or elsewhere. They earn a profit from the difference between the rate of interest charged on loans and the rate of interest paid on the deposits. And they meet the short term as well as the long term needs of the borrowers, and they provide liquidity to the savers. That is what we understand by the financial intermediaries or the financial institutions. Let us discuss the features or the characteristics of financial institutions. The first feature is that the financial institutions act as intermediaries or the middlemen between the savers and the borrowers. And the financial institutions provide mobility of funds. They also provide safety, liquidity, and profitability to the investors and the depositors. The next feature is the financial activities. The financial institutions, they provide short, medium, and even long-term finances to various users of funds. So they finance almost all activities in the economy. And the financial institutions play an important role in the development of the money market as well as the capital market. These institutions help in the economic development of a nation. They help it by providing financial resources, promotional activities. They even help in accelerating the industrialization. In fact, the economic development of a country depends upon a well organized financial institution system. And then it is different from the brokers. The brokers do not mobilize savings, but financial institutions mobilize savings of the surplus units and lend them to the borrowers. Both brokers and financial institutions help in making the savers and borrowers meet. But the brokers do not mobilize savings while financial institutions mobilize the savings. And the next point is that the financial institutions provide advisory services. They provide advices to investors, to the borrowers, business houses, government on various issues like restructuring, diversification, etc. And now let us discuss the role of financial institutions in an economy. Their important role is providing funds. The underdeveloped countries, they normally have low levels of capital formation, and due to the low incomes, people are not able to save sufficient funds. And we know that fund is always important for setting up of new units and for the expansion, diversification, and even the modernization of existing units. But people do not have approach to such funds. So these people who have capability of starting business but they do not have requisite fund or any access to requisite fund, they can approach the financial institutions for help. And these institutions help a large number of persons for taking up some industrial activity. the addition of new industrial units, and increasing the activities of existing units will all help in accelerating the pace of economic development of a country. And the financial institutions have large investable funds which are used for the productive purposes. So they provide funds to those who have no access to funds. And the next point is the infrastructural facilities. Actually, the economic development of a country is linked to the availability of infrastructural facilities. There is a need for roads, there is need for water, communication facilities, and there is also need for electricity and many other infrastructural facilities. And the financial institutions prepare their investment policies by keeping these national priorities in mind. The institutions invest in those areas which can help in increasing the development of the country. And we can see that the Indian industry and agriculture is facing acute shortage of electricity. These investments, or we can say the investments of the financial institutions, are giving priority to invest funds in projects generating electricity. These investments will certainly increase the availability of electricity. And the small entrepreneurs, they cannot spend funds for creating infrastructural facilities. To overcome this problem, the institutions are developing industrial estates and even sheds. And all the infrastructural facilities are provided to them, either free of cost or at a very low cost. So we can say that the financial institutions are helping in the creation of a variety of infrastructural facilities which are essential for the development of a country. And the next point is the promotional activities provided by the financial institutions. An entrepreneur normally faces many problems while setting up a new unit. They may have to undertake a feasibility report, they may have to prepare project report, and they have to complete registration formalities, seek approval from various agencies, etc. All these things require time, money, and energy. Some people are not even able to undertake these things, or some do not even take such initiative. The financial institutions have the expertise and the manpower resources for undertaking these sort of activities. So, these institutions take up this work on behalf of the entrepreneurs. Some units may set up jointly with some financial institutions, and in that case, the formalities are completed collectively by these units as well as the financial institutions. Some units may not have come up had they not received the promotional help. That means if the financial institutions were not there to help them, they would not have been able to set up their unit. So, the promotional role of financial institutions is very much helpful in increasing the development of a country. And then some areas remain neglected because facilities needed for setting up of new units are not available there. The entrepreneurs set up new units at those places which are already developed because it is easy for them to set up their unit there. And this causes imbalance in the economic development of some areas. And in order to help the development of backward areas, what the financial institutions do is they provide special assistance to the entrepreneurs for setting up new units in these areas. For example, the IDBI, IFCI, ICICI, etc. give priority in giving assistance to units to set up in the backward areas, and even charge lower interest rates on lending. Such efforts certainly encourage the entrepreneurs to set up new units, especially in the backward areas. And thus, it helps in improving the basic amenities and also to create employment opportunities in these backward areas, which will eventually help in the development of the backward areas. And the next point is that the financial institutions help in the planned development of the economy. Some institutions help different segments like foreign trade, tourism, etc. And they also provide loans to a variety of sectors in the economy. So we can say that the financial institutions have their own role in the development of the economy. These financial institutions also follow the development priorities set by the central and the state governments. They give a preference to those industrial activities which have been specified in industrial policy and in 5-year plans. Financial institutions help in overall development of the country. And our next point is financial institutions help in accelerating the industrialization of a country. We know that the economic development of a country is directly linked to the level of industrialization. The setting up of more and more industrial units will generate direct and indirect employment opportunities. And in addition to that, they make goods and services available in the country and also help in increasing the standard of living. So we know that the financial institutions are supporting for the setting up of these industrial units, and thereby they have got a key role in accelerating the pace of industrialization in the country. Another point is the employment generation. By supporting in setting up of new units, either in the developed area or in the backward area, they help in creating more and more employment opportunities to the people. So they have employed many persons to man their offices as well as they have supported in employment generation by setting up of new units by providing all the support required for setting up of these units. And now we can find the different types of financial institution. For this purpose, let us classify the financial institutions into two: banking financial institutions and non-banking financial institutions. And both the banking financial institutions and non-banking financial institutions can be further classified into two as organized and unorganized. And in the case of banking financial institutions, the organized sector consists of commercial banks and cooperative banks, and their unorganized sector consists of the indigenous bankers, money lenders, sahugars, etc. And in the case of non-banking financial institutions, the organized sector can again be classified into three as development banks, specialized financial institutions, and investment institutions. The development banks include the All India Development Banks like IDBI, IFCI, ICICI, SIDBI, etc., and the state level development banks like SFC, SIDC, etc. The specialized financial institutions include Exim Bank, NABARD, etc. And the investment institutions include LIC, GIC, UTI, etc. And the unorganized non-banking financial institutions include the non-banking financial companies coming in the unorganized sector. So that's all about the financial institutions. Thank you for watching this video. For more videos, subscribe the channel.